So today we're going to be talking about DSCR loans, otherwise known as a debt service coverage ratio loan, and how they can scale your investment portfolio. Now, while it's true, money is more expensive right now to borrow, it can be relatively easy to get with the right financing tool. And the DSCR loan is a bit different than the loans you might be used to, and there are some nuances to consider. Hi, my name is Jeremy. I educate homebuyers and homeowners. I empower realtors, and I unleash investors by making the mortgage process easy. I work as a full-time mortgage broker and investor. I've originated hundreds of loans, and I use these same exact financing tools in my own portfolio. In this video, I'm going to be going over how DSCR loans work, the things to look out for, the pros and cons, and I'll also give you a list of my top tips in order to save you the most amount of money. Let's get into it. First of all, let's talk about why you would want a DSCR loan. If you were to buy a conventional home from a bank, you're going to need to show W-2s, you're going to need to show tax returns, 1099s, you're going to need to provide a lot of income documentation. And on top of that, you can only have 10 properties financed on your credit at any one time. And they're going to base the amount that you can borrow off of what's called your debt to income ratio. So they're going to look at all of your debts and liabilities on your credit monthly, and they're only going to allow you to use a certain percentage of your income. The idea here is investors with 10 properties, they're going to need to either sell one or refinance one into a different type of loan product just in order to get another loan, right? So it's very limiting. With the DSCR loan, the income that's required for this type of loan is based on the property and not you. The ability for your property to generate cash flow every month is what matters the most. Hey, thanks so much for sticking around. If you enjoy the content, please drop a like below and continue to enjoy the rest of the video. Now, the downside to a DSCR loan is it is a bit more expensive than regular financing options. Now, since these loans are for investment purposes only, investment purchases tend to carry a higher risk profile, so you're going to pay for that higher risk with a higher interest rate. Now, you're also going to pay for fees. You're going to have processing fees, origination fees, appraisal, and many of the other fees you would find in a conventional loan. Now, a few of the questions that you're going to be asked when you start the DSCR loan process are going to be your specific information, right? Your contact information. They're going to ask about your name, your LLC's name, if that's the route that you're going to go there. They're going to ask for an estimated credit score because that's an important part of the process. They'll ask you for things about the property, obviously, the address, and they're also going to look at details like your tax information and your insurance information so that we can calculate those monthly expenses. And then now when we review this information, the cool part is we're going to check your work. Right, so you almost have an underwriter or like an assistant, if you will, that's sort of going over the deal to make sure that the deal is actually going to be a good fit for what you're looking to do and the type of loan you're seeking. We'll then order a full appraisal to check the market value of the property. Additionally, we'll also check the market rent of the property, also through the appraisal. And then we'll lastly review a few bank statements to make sure that we have the requisite amount of reserves on hand. And reserves are nothing more than your total monthly debt service payment, right? So that would be your principal, your interest, taxes and insurance, and HOA dues if those are applicable. A lot of lenders will want to see 3 months, 6 months, maybe 9 months of those reserves. Some deals are a little bit different and require more, but they just want to make sure that if you have vacancies or if you're stabilizing the property after you acquire it, that you have the reserves on standby in case you need to make those payments and there's nobody in there quite generating cash flow yet. But what type of properties can you get with a DSCR loan? Well, you can get all kinds. So you can get single family homes. That's probably the most common one that I deal with. You can get 2 to 4 units. You can get 5 to 8 units, in some cases up to 12 units. You can also do condominiums, townhomes. You can do PUDs or planned urban development homes, so large HOA neighborhoods. You can do all kinds of properties using the DSCR loan. Your credit score is also going to be a huge factor. Now, this will dictate not just the amount of the loan that you can borrow, based on the value of the property, and we call that LTV or loan to value, but it'll also generate your interest rate and the cost for that interest rate. For example, if you had a 680 FICO score, you're going to be able to borrow a certain percentage of the value of that home, maybe 60, 65%, maybe 70% in some cases. But if you have a 780 or even an 800 credit score, you might be able to push up that value percentage even higher, 75, 80, even 85% of the value in some cases for purchases and for rate and term refinances. Now, how long do these DSCR loans take to complete? Well, usually what I'll tell folks is about 30 days. And the reason for that is we still have to go through a full appraisal process with a rent schedule that's completed with the appraisal process. And it is not as fast or as flexible as a hard money loan, for example, and definitely is not as fast as a cash deal. Now, what is the math behind the DSCR ratio, the debt service coverage ratio? Well, what you do is you'll take market rent and then you're going to divide it by the dollar amount of your debt service every month. And again, that's principal, interest, taxes, insurance, and HOA if you have an HOA. You divide the first number by the second, that gives you a ratio. So for example, if you have a $2,000 monthly income coming in and your total debt service all in every month is $2,000, well, that's a ratio of 1. Pretty easy. If you have $2,500 a month coming in cash flow and your debt service is $2,000 a month, that is a 1.25 debt service coverage ratio. Now, the cool part about 1.25 on the ratio is that's stronger than 1.0, and sometimes that will give you a break on the interest rate or the cost. Now, what happens when the ratio is less than 1? It's okay. There are options for that. Now, as you can imagine, if you are in a negative cash flow situation, which is what happens when your ratio is less than 1, you can imagine there's going to be more risk with that. So that loan might cost more. The rate might be higher, the cost might be higher, but it can be done. Here's why. So some investors might have a different strategy than what the market rent is calculated on. Most market rents are calculated on long-term lease numbers. And some appraisals will do short-term rental numbers, and there's different options there. But listen, if you're going to purchase a property, you're going to enclose the garage and create a living area there, which you could rent out for $1,000 or $1,200 a month. Sometimes that figure is not going to be accounted for in your appraisal, right? So that's why these options exist for low or no ratio. Another example might be if an investor is going to use that property for a different form of rental, let's say a midterm rental or a corporate rental. Some investors will do an assisted living facility by buying a property and then converting that property over time and setting up a business out of that property. So all these different uses mean that sometimes your ratio is not going to quite be there during underwriting, but there are programs that exist for you. Now, what is the process for a DSCR loan? So first thing first, you're going to get under contract. So your seller's going to agree to your terms, and then you're going to put up earnest money. Now that earnest money goes to the title company to open escrow. We'll then order an inspection. That's a third-party service that you do on your own with your agent or yourself if you're not represented. And then I'll order the appraisal right around the same time. So that appraisal is also a third-party service like the inspection. It can run anywhere from $500 to $1,000 or anywhere in between for most transactions. The more complex ones might be a little bit higher. And we get the appraisal back. We'll reconcile the numbers to make sure the rents look good, to make sure the value looks good. And then we'll clear up the last remaining conditions and we'll get the last few documents needed in order to get us into closing. Now, how do lenders calculate your rates and your cost for DSCR loans? Now, each lender is going to have their own rate sheet, and those are usually private. So that's why you deal directly with a lender or a mortgage broker, loan officer, and you'll get an idea of what your interest rate and your cost is at face value as you start the process. Things like your borrower profile, how experienced are you? For example, how many properties have you purchased or how many rentals do you own over the last 3 or 5 years? That affects your pricing. What is your LTV? So what percentage of the value are you trying to borrow? Are you trying to borrow as much as possible based on that lender's criteria? That might cost you more than if you just said, hey, I want to borrow half of this home's value. That also affects your pricing. And other factors are included that are specific to the property. So if it's a condominium, sometimes condominiums for investments, they tend to price a little bit higher than townhomes or single family homes. And then multifamilies, duplexes, triplexes, fourplexes, and larger multifamilies, they'll also charge a bit more on rate and cost than you might find for a single family home. So all these factors can influence your pricing. So if you have a property that's worth $400,000 and you want to borrow 75% of that $400,000, that's likely going to cost a bit more in rate than if you just said, I'd like to borrow 30 or 40% of $400,000. And another factor to consider with pricing is going to be your term. Most of the DSCR loans that we do are 30-year fixed. We do have some 30-year interest-only options, and that's a cool feature because first 10 years, you're going to pay interest only, which is a lower payment than if you had a fully amortized 30-year fixed loan. After that 10-year period is over, that 20-year period that's remaining becomes amortized. So the payment goes up quite a bit. Now, the interest only payment is less, and that can help you qualify. So it could put you into a threshold where now you're over that 1.0 ratio, which gives you eligibility, gives you the green light. And you'll also see things like 40-year fixed loans out there and 40-year interest-only loans. The payment figure is not going to be as low as you might think it would be going from 30 to 40 years. It's only used in certain situations. It's not something I'd usually recommend, but it depends on the solution that we're trying to find for your financing need. And then you also have adjustable rate mortgages, but more on that in another video. Now, another pricing factor is going to be the state where you're buying in. Every state, slightly different regulations, slightly different risk factors are present. And these change constantly. They are not fixed. So it's critical to have a loan officer advisor that knows the investment side of the financing world and can give you that feedback real time as you're coming across these deals to underwrite. Another pricing factor would be citizenship. A lot of people are surprised to learn that US citizens get a better price than, let's say, foreign nationals. One more price factor, you can increase or decrease your interest rate depending on how long you want to hold the home for. Enter the prepayment penalty. Now, primary homes do not have this feature, but for investment homes, the prepayment penalty is essentially the lender saying, hey, we want to make X amount of interest on your loan. We don't want you to pay it off too early. So if you want to have this loan in place for, let's say, 5 years, we will give you the lowest rate on our rate sheet. But if you can't guarantee that and you want 0 years, we're going to make the rate the most expensive on the rate sheet. And then there's all these little stops in between, 1, 2, 3, 4, 5 years, with 5 years being the cheapest and 0 years most expensive because the lender wants their interest. They want to make their money too. Now for you, my feedback is if you buy a property and you know you're never going to sell, go with the longest prepayment period option available because that makes your rate the lowest. If you're unsure, or if this is something you might change your strategy on in 2 or 3 years, go with a lower prepayment penalty so you do not get hit with these fees. They can add up. Now, what happens if you pay off the loan early during the prepayment penalty period? Huge nugget here. There are 3 different types of prepayment penalties, and I have all 3 in my portfolio. So listen close. First, you have the fixed percentage penalty. Let's say we have a 5-year prepayment. At any point in that 5 years, I might have to pay, let's say, 5% of the unpaid balance off if I pay that loan off anytime in 5 years. Second, you could have an interest percentage penalty, and all that is a certain amount of interest that would have been paid over a specified period of time. For example, if I paid off a loan early in that 5-year prepayment penalty window, it could be something like 6 months of unpaid interest on the balance. So you would take your balance of your loan, you would calculate 6 months worth of interest, that would be your prepayment penalty there. Now third, you have the sliding scale penalty. Now the sliding scale penalty is a decreasing penalty the more that the loan matures. So for example, in that same 5-year prepayment penalty period, if you pay off the loan in year 1, you might pay 5% of the unpaid balance in your penalty. If you pay it off in year 2, it could be 4%. If you pay it off in 3%. If you pay it off in year 4, 2%. And if you pay it off in year 5, it's only 1% of the unpaid balance. Now here's a little known fact about DSCR cash out loans. They have what's called a seasoning period requirement. You have to have that property vested for a period of time before you can pull cash out of the property. There are lenders we have access to where sometimes those seasoning requirements are 6 months. In some cases, they're 3 months. But we do have options where it's 0 months. But it is something to be aware of, especially if you are using the BRRRR method. A lot of times investors will acquire a property with private cash or hard money, and then they'll turn around right away and look to DSCR cash out refinance to pull all that cash out and then anything extra that they can get based on the value of the property to put into their pocket. You need to check your seasoning requirement because sometimes you'll be sitting for months waiting for that period to be over unless you talk to the right lender. All right, if you enjoyed this video, it would mean the world to me if you press the subscribe button. I promise to only kick out valuable information to help you in your home ownership or home investment journey. Okay. Whew, that was a lot. There's a few more things I want to give you. I'll give you some of my best tips for getting the cheapest DSCR rate that you can. Here we go. Number one, fix your credit. So unless your credit score is 740 and above, you should get that score up there as soon as possible if this is a financing strategy that you want to use. So for every 20 points of your credit score, the loan to value and the rate and then the cost will change or could change. So for example, between 680 and 700, that might not be as cost effective of a loan for you as 700 to 720 on your FICO. 720 and 740 could also be a little bit better than 700 to 720. So get your credit right. It'll save you tens of thousands in the long run, if not more. I can't stress that enough. Number two, check the price on what you need to borrow versus the price on what you want to borrow, because sometimes there's a difference between borrowing 60% of the value of a house and 65%, or 65 and 70, for example. Those could be different pricing. Know your numbers. Number three, your ratio, it matters. It's not just 1.0 and higher and then you're in good shape. Listen, if you get 1.25, that could increase your pricing dramatically. If you can get your pricing up to 1.5, in some cases, I've seen rates get low enough that they're comparable to conventional rates right now in this environment. Now, the other side is also true. If you have a low or no ratio as part of your underwriting and your rate's going to be higher and the cost might be a little bit higher, make sure that your exit strategy for how you're going to generate cash flow is sound. It is critical once you close on this deal that you get that place tenanted, get it stabilized, and start making that cash flow. You do not want to be pinched. And I see a situation in the future here where a lot of investors with high interest rate DSCR loans are going to go in default. And this is horrible. You don't want that. Check your numbers. Number four, check the cost between rate and term and cash out. So a rate and term DSCR loan is just going to cover the outstanding mortgage liability against that property. If you do cash out, you're paying off that existing mortgage in some cases, and then you're taking out some on top of that. The cash out loan is more expensive than the rate and term loan. Check your numbers. Number five, the type of property matters here. So condos could be more expensive, for example. Townhomes and single family homes would be a little bit cheaper. You might see one price for a 2 to 4 unit DSCR loan versus a different price for, let's say, 5 to 8 units, or even 5 up to 12 units. So know those numbers as well and compare the difference. When you have a property that has that many units, you need to talk to a few different lenders or connect with a mortgage broker that has several different lenders with which to price from. Number six, go with the longest prepayment term that you can. I'm a firm believer in if I buy something, I never want to sell it. So we usually go with higher prepayment penalties for most of our acquisitions. But listen, this is a tool that's going to save you a ton of money long term if your goal is to hold for long term. Just maximize your prepayment penalty wherever it makes sense. It can also be like forced savings, right? That piggy bank stays nice and fat. It keeps getting filled. So when you break it open down the road, you've got a lot of coins spitting out of there, right? Because of all the properties you acquired and you extended your prepayment penalty as much as possible so you could save on all that interest throughout the duration of the note. Now, if you want a DSCR product specific for your purpose and your property, I'd be honored to assist. I'm a nationwide mortgage broker. I own properties myself with DSCR loans, so I'm familiar with the process. I've helped other investors do the same, and honestly, investors are my favorite people on the planet, other than you, Mom. Now, if you want a DSCR product specific to your needs, I'd be honored to assist. I'm a nationwide mortgage broker based in Phoenix, Arizona. We own properties in several different states. We use DSCR loans frequently for our acquisitions. And honestly, I love working with investors. They are my favorite people on the planet. Well, other than you, Mom. Now, if you're somebody that wants to go deeper on this topic, I help investors create wealth by using leverage. I have a freebie in the description. Go down there, click the link, check it out. Thanks so much for tuning in, and I'll see you in the next video.